In late July of 2025, the donut maker Krispy Kreme saw its share price surge for no apparent reason. It was caught up in a so-called meme rally, where retail investors pile into a stock hoping to catalyze a short squeeze. Krispy Kreme was a good candidate for a meme rally. It's a recognizable brand that most retail investors will have heard of, and it has a very high short interest. So why does Krispy Kreme have a high short interest in the first place? The company has not been doing very well. Over the past year, the company's revenue and profits have collapsed. Krispy Kreme went public in 2021. Since then, its share price has declined by more than 80% until the recent meme rally. Krispy Kreme has a very long history, going back almost a century. And in fact, they've actually done two separate IPOs, the first one happening in 2000. In this video, we'll look at how Krispy Kreme became one of the largest donut chains in the world, the recent difficulties they've faced, and how they ended up as a meme stock. This video is sponsored by Strawberry.me, a platform that connects ambitious professionals with certified personal coaches to help them achieve meaningful career growth. In today's job market, hard work alone often isn't enough. Whether you're aiming for a promotion, planning a career shift, or feeling stuck in your current role, a clear strategy can be the difference between stagnation and progress. That's where Strawberry.me comes in. Strawberry.me makes it easy to get matched with a certified coach who specializes in your area of need, whether that's leadership development, navigating a job search, or building long-term career momentum. All coaches are trained through reputable programs accredited by the International Coaching Federation, and the platform is designed for accessibility, flexibility, and results. Unlike therapy or consulting, coaching is a collaborative, goal-focused process. Coaches help clarify what you want, identify the roadblocks, and guide you in developing a strategy that plays to your strengths, without giving cookie-cutter advice or one-size-fits-all solutions. In just a few clicks, you can get matched with a certified coach based on your goals, preferences, and availability. Everything is done online, no long wait lists, no office visits, no complicated onboarding. You choose a time that works for you and meet virtually from anywhere. Success doesn't happen by accident, it's built through action and accountability. To get started, take the free quiz at strawberry.me/wallstreet to get matched with your ideal coach. That's strawberry.me/wallstreet. You'll never regret investing in yourself. In 1937, Vernon Rudolph purchased a secret recipe for yeast-raised donuts from a French chef in New Orleans. With this recipe in hand, he rented a building in North Carolina and built a bunch of equipment to mass-produce donuts. He started selling the donuts to local grocery stores under the Krispy Kreme brand name. In addition to selling to grocery stores, he set up a window at his donut factory where consumers could buy the donuts directly. This is called a factory store because it serves both as a donut factory and a retail store. The first factory store was immediately a huge success. The donut making machines were visibly placed behind glass. Because the donuts are made on site, they're still fresh and warm when you buy them. Consumers would come to Krispy Kreme not just because they liked the taste and freshness of the donuts, but also for the novelty of seeing the donut machine operating in real time. In the later half of the 20th century, Krispy Kreme gradually expanded its retail presence across the United States, both with company-owned stores and franchises. In the 1990s, Krispy Kreme started a new franchise model designed to accelerate growth. They granted so-called area development franchises. They would partner with large franchisees with significant funding. They would grant these franchise partners exclusive rights to operate Krispy Kreme locations in specific metropolitan areas. For example, one franchise group might have the rights to operate Krispy Kreme locations in the New York City area. This franchisee can strategically place Krispy Kreme locations throughout the city. The franchisees must purchase the proprietary donut making equipment and donut mixes from the Krispy Kreme Corporation. The franchisee pays for all the capital expenditures associated with opening the new stores and pays 4.5% of revenue to Krispy Kreme as a royalty. While the factory stores were highly successful, they took up a lot of space and were expensive to build. So in the early 2000s, they started establishing so-called satellite stores. These are much smaller stores that do not make the donuts on site. Donuts are shipped from the factory stores to the satellite stores on a daily basis. The franchising model allowed Krispy Kreme to expand very rapidly in the 1990s and 2000s. In 2000, Krispy Kreme IPO'd on the New York Stock Exchange. They immediately became one of the most popular stocks on Wall Street. The company was growing fast. In 1999, they had 144 stores, including both company-owned stores and franchises. By 2003, their store count had almost tripled to 386. In 1999, the company generated $220 million of revenue and an operating profit of $11 million. By 2003, their revenue had increased to $659 million, and their operating profit grew to $92 million. Their IPO was priced at $5.25 per share, adjusted for subsequent stock splits. On the very first day, the stock more than doubled. In 2004, the stock price peaked at $48, an 8-fold increase in just 4 years. But then its stock price collapsed and fell to as low as $5 in 2005. So what happened? In the preceding years, the company's revenue was skyrocketing both because they were rapidly opening new stores and because sales at existing stores were increasing. Throughout 2002 and 2003, their comparable store sales were increasing at an annualized rate of approximately 10%. Comparable store sales growth measures the growth in sales for stores that have already existed for more than 1 year. It thus strips out the effect of new store openings. In the quarter ended May 2004, comparable store sales only grew by 4% versus the year-ago period. In the quarter ended August 2004, comparable store sales were flat. In the November quarter, they fell by more than 7%. In the space of just a year, Krispy Kreme had gone from a growing business to a declining one. CEO Scott Livingood tried to blame the sales shortfall on increased health consciousness among the general population. People were supposedly switching to low-carb diets. However, this was just a coat by Livingood, who was trying to shift the blame away from himself. In 2004, the US obesity rate increased to a record high of 32% and has increased every single year thereafter. There's no sign of any low-carb diets. In reality, the company had expanded way too fast. The donuts themselves were nothing special. There are plenty of competitors, including national chains like Dunkin' Donuts and thousands of independent donut shops around the country. The reason Krispy Kreme was so successful was because of their factory store concept. People come to Krispy Kreme to see the massive donut making machines, but the novelty wears off quickly. When a new Krispy Kreme location opens, it typically sees massive sales in the first week, in some cases as much as $500,000, but sales rapidly declined thereafter. As early as 2003, Krispy Kreme's senior management could see that business wasn't going quite as well as they had led Wall Street to believe, so they started massaging the numbers so as to meet analysts' expectations. In October of 2004, the Securities and Exchange Commission opened a probe into the company's accounting practices. The SEC eventually uncovered a number of manipulations Krispy Kreme had done to artificially inflate its reported profits. Remember that Krispy Kreme has company-owned stores and franchised stores. By the early 2000s, the majority of Krispy Kreme stores were franchises. Sometimes Krispy Kreme would buy out its franchisees. In June of 2003, Krispy Kreme wanted to do a partial buyout of one of its franchisees in Texas. This franchisee operated multiple locations, and Krispy Kreme only wanted to buy a portion of them. They agreed on a purchase price of $65 million, but before the deal closed, Krispy Kreme offered to increase the purchase price by $800,000. In return, the franchisee agreed to purchase $800,000 of donut-making equipment from Krispy Kreme, which would be used at the franchisee's remaining locations. The franchisee didn't really need this new equipment. They already had enough equipment, but they were effectively getting it for free, so why not? Krispy Kreme recognized $800,000 of revenue from the sale of this superfluous equipment. The $800,000 that Krispy Kreme paid to the franchisee is categorized as an investment, not an expense. It thus does not show up on the income statement. Thus, Krispy Kreme can recognize $800,000 of high-margin equipment sales, which increases its reported profits. This profit is fictitious. In reality, Krispy Kreme lost money because they effectively gave the equipment away for free. This type of transaction is called a round-trip investment and is illegal. In total, the SEC identified 3 round-trip investments Krispy Kreme conducted with its franchisees. According to the SEC, these round-trip investments allowed Krispy Kreme to overstate its profits by $2.4 million in 2003 and $8.5 million in 2004. In 2003, the company's real operating profit was $92 million, so they inflated it by only a couple of percent. In 2004, their real operating profit was $22 million, so they inflated it by almost 40%. In January of 2005, CEO Scott Livingood was fired by the board of directors. This was due to the company's deteriorating financial performance, as well as the accounting scandal. Following years of strong growth, Krispy Kreme's revenue peaked at $708 million in 2004. It started to decline precipitously thereafter, troughing at $347 million in 2009. The orange bars show the company's adjusted operating profit. This excludes non-recurring items such as impairment charges, lease termination costs, and litigation settlements. In 2005, Krispy Kreme reported an adjusted operating loss of $28 million, but thanks to cost cuts and an increased focus on franchising, profitability gradually recovered thereafter. The total number of Krispy Kreme stores peaked at 433 in 2004. In 2005 and 2006, Krispy Kreme itself and many of its franchisees closed underperforming stores as sales volume declined. By 2006, the number of stores had fallen to 396. The total number of stores started increasing again in 2007. By this point, Krispy Kreme made the decision to focus more on franchises. They continued closing company-owned stores. The number of stores owned by the company itself continued declining, reaching a trough of just 83 in 2009. Since 2008, almost all of Krispy Kreme's new store openings have been done by international franchisees. The company started international franchises in the early 2000s, but they only started disclosing the number of international franchises in 2008. By 2015, there were 1,121 Krispy Kreme stores worldwide, of which 824 were international franchises, 181 were domestic franchises, and only 116 were company-owned. Krispy Kreme has become popular in Mexico and the United Kingdom, and they've been surprisingly successful in South Korea, Japan, and the Philippines, despite these countries having very different culinary traditions. Despite company-owned stores representing a small minority of total stores, they accounted for the majority of the company's revenue. This is because for franchise stores, Krispy Kreme only recognizes the 4.5% royalty as revenue. They have a third revenue segment called Krispy Kreme Supply Chain. This is the donut making equipment and donut mixes that Krispy Kreme sells to its franchisees. While the franchises represent a small percentage of revenue, they represent the vast majority of the profits. On this chart, we have Krispy Kreme's operating profit by segment. The total segment profit is always greater than the company's reported operating profit because it does not include unallocated corporate overhead. In the early 2000s, Krispy Kreme's company-owned stores were highly profitable. As the store count expanded and the novelty of the factory stores wore off, sales and profitability per store declined. In both 2008 and 2010, the company-owned stores incurred losses. While the company-owned stores are sometimes unprofitable, the franchise segment is always profitable. Krispy Kreme just takes a 4.5% royalty while incurring almost no cost of its own. So even if the franchisee is unprofitable, Krispy Kreme itself will still make a profit. The franchisees also form a captive market for donut making equipment and dough, which Krispy Kreme sells to them at a significant markup. The largest factory stores can make up to 10,000 dozens of donuts per day. These are sold at the factory store itself and also shipped to satellite stores. As sales per store decline, the company has increasingly sold the excess capacity to local grocery stores at cheaper wholesale prices. Both company-owned and franchised factory stores sell their excess production to grocery stores. In the United States, Krispy Kreme's popularity has never recovered to its peak from the early 2000s. In 2001, Krispy Kreme's company-owned stores generated $3.5 million of revenue each. Throughout the late 2000s and early 2010s, revenue per store stabilized at roughly $3 million. Krispy Kreme has long since reached saturation in the US. The company was nonetheless able to return to growth by focusing on expanding its profitable franchise business to foreign countries. In 2016, Krispy Kreme was acquired by a private equity firm called JAB for $1.35 billion. This marked an end to the company's first wild ride on the public markets. After owning Krispy Kreme for 5 years, JAB decided they wanted to cash out. So in 2021, the company conducted its second IPO. The IPO priced the company's shares at $17, giving it a valuation of $2.7 billion. This is double the price JAB purchased the company for in 2016. Between 2016 and 2021, JAB made a number of changes to Krispy Kreme's business strategy. In the past, Krispy Kreme focused mainly on its factory stores. These are large, expensive, and the novelty of seeing the donut machines in action was already saturated. So they decided to shift to a new strategy which they called omnichannel and fresh points of access. They focused more on quality control. And finally, they de-emphasized the franchise model, such that the company itself can have more control. Krispy Kreme had long sold its excess inventory to local grocery stores, but this was done in a disjointed manner. Many factory stores were owned by franchises who did not coordinate very much with Krispy Kreme corporate. This resulted in an inconsistent retail experience. In grocery stores, Krispy Kreme donuts were often placed on tables haphazardly along with other random products. By the time a customer buys them, they may be days old and stale. Between 2018 and 2021, Krispy Kreme spent close to $500 million to buy out all of its franchisees in the United States, and most of its international franchisees as well. They set up thousands of branded kiosks in grocery stores, convenience stores, and fast food restaurants, including McDonald's. They developed their own centralized logistics operations to deliver fresh donuts to these kiosks every day. These are called Daily Fresh Delivered or DFD kiosks. When a consumer buys donuts from these kiosks, they know they are less than 1 day old. They also started selling donuts online through food delivery platforms including DoorDash and Uber Eats. In 2018, Krispy Kreme paid $140 million to acquire a 75% stake in a cookie retailer called Insomnia Cookies. Insomnia Cookies operates retail stores across the United States and also delivers cookies over the internet. Krispy Kreme used the proceeds from its IPO to expand rapidly. In 2021, they had 10,427 global points of access, of which 1,844 were actual Krispy Kreme stores, and 8,583 were DFD kiosks placed within other retailers. By 2024, their number of stores increased to 2,125, and their DFD kiosks increased to 15,432, giving them almost 18,000 global points of access. As they rapidly expanded, they quickly hit market saturation, with their newly opened kiosks cannibalizing existing ones. Their revenue per access point declined from $133,000 in 2021 to $95,000 in 2024. As their number of locations increased, so too did their delivery expenses. They have to send delivery trucks to every one of the DFD kiosks every day to deliver fresh donuts, even as the number of donuts sold per kiosks declines. To make matters worse, the company is burdened by a massive debt load, as they previously borrowed money to buy out their franchisees. In July of 2024, they sold their majority stake in Insomnia Cookies for $127 million, using the proceeds to pay down debt. Despite this, they still ended the year with $900 million of debt, which accrues interest at a rate of $60 million per year. In 2021, Krispy Kreme generated $1.4 billion of revenue. They reported an operating profit of $41 million, representing a razor-thin margin of just 3%. But this wasn't even enough to cover their interest expense of $43 million. Over the following 2 years, their revenue grew, reaching $1.7 billion in 2023. But their profits declined due to increased logistics costs. In 2024, their revenue declined marginally, despite the fact that they opened 3,400 new global points of access that year. Their new DFD kiosks were just cannibalizing the old ones. They incurred an operating loss of $3 million and incurred $60 million of interest expense. With a declining, money-losing business and a massive debt load, Krispy Kreme's outlook has become very bleak indeed. Their stock price declined more than 80% since the IPO, and short sellers piled into the stock hoping to profit from the company's demise. The high short interest drew the attention of retail investors who started buying the stock hoping to catalyze a short squeeze. The company may soon take advantage of the inflated share price to raise capital by issuing new shares. This lifeline could last them a few more quarters, but it will not change the company's bleak situation in the long term. Alright guys, that wraps it up for this video. What do you think about Krispy Kreme? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.